Over the past 2 years, real estate investment trusts saw their share prices crash even as most of them kept on growing their cash flows and dividend payments. As a result, it's now not unusual to find even large REITs like Public Storage, Prologis or American Tower with about 30% lower share prices, even as they've grown their cash flow by another 20% over the past 2 years. And so what this essentially means is that now you get to buy these same REITs with about 2 times lower valuation multiples. In fact, REIT valuations are today the lowest since the great financial crisis. But interestingly, despite these very low valuations, there are very few investors who seem to be interested in REITs today. They are out of favor because of the surge in interest rates, and very few investors are buying them. But I'm here to warn you today. I think that the window of opportunity could be closing. I think that REITs could strongly recover already in the near term, in the next 6, 12 or 24 months. I cannot predict exactly when the recovery will take place. None of us can time the market, but I think that we're about to see an epic recovery, and today's video I'm going to explain to you why. Hey, this is Yoshi. I run a small investment firm that specializes in REIT investing. I'm about to talk to you about 2 powerful catalysts that could push REIT share prices a lot higher already in the near term. But before I get into it, I want to remind you that we just recently launched a new YouTube channel to discuss our favorite non-REIT investment opportunities. We are now approaching 1,000 subscribers. We've already highlighted some of our top picks in which I'm also investing. I'll put a link to it in the description of this video and would strongly recommend that you check it out. So why am I posting this warning today? Why do I think that REITs are likely to recover in the near term? It really boils down to 2 main things. I expect us to see quite significant rate cuts already in the near term, and this is going to be combined with an acceleration in rent growth in most property sectors. And these 2 things combined together, I think, are very powerful catalysts that could lead to an epic recovery in the REIT sector. So let's start here with interest rates. We all know that interest rates were hiked at an unprecedented pace over the past 2 years to fight the high inflation that followed the pandemic. This inflation happened because we had significant supply chain issues, we had a lot of stimulus checks going around and distorted consumer behavior as well, because for a while we're locked inside our homes or a lot of public facilities were closed, so people were spending more money on goods rather than services, right as there were supply chain issues at the same time. So this led to a lot of inflation, but now we've moved past the pandemic, things have gradually normalized. And so inflation has cooled down quite significantly. The headline rate is now at about 3%. If you adjust for a real-time shelter, it's actually closer to 2% already. And so because of that, the Fed has made it quite clear that the next move is likely to be a rate cut rather than a rate hike. And we've even seen now central banks elsewhere in the world cut their interest rates. Canada just cut their rate. The Eurozone just cut its interest rate as well. And I think that these are pretty strong leading indicators for what's to come in the US as well. And even in its commentary, the Fed has made it pretty clear that we're likely to see rate cuts in the near term, because these high interest rates that we currently have, which are still at a multi-decade high, really aren't needed anymore since they've served their purpose. Inflation has cooled down and now they're becoming restrictive on the economy, and so it might cause more pain than good going forward. The Fed Watch tool is now predicting roughly a 75 to 100 basis point rate cut over the next 1 year. And I think this is very significant for REITs, because we need to remember here that REITs crashed really because of one reason, it's the surge in interest rates. And so it would seem very logical for them to also now recover as interest rates are cut in the near term. Here again, I cannot predict exactly when interest rates will be cut, but we really don't need to know that. This could happen in September, it could happen in early 2025. What matters is that it's quite clear that the direction is towards lower interest rates, and this is a very strong catalyst for the REIT sector. Right now, there are still a lot of income-oriented investors who are hiding in treasuries and money market funds earning a roughly 5% yield. But as soon as these rates are cut, even by just 25 basis points, these investors will quickly realize that this 5% yield that they were expecting was just a mirage there. They're not really going to earn as much. And so I expect a lot of this capital that left the REIT sector to fixed income to come right back into the REIT sector as they come in to capitalize on the high yield and low valuations before REITs recover. I think that this on its own is a very strong catalyst for REITs. Simply lower interest rate could lead to a pretty strong recovery, but that's not all. I think that we're also going to see a strong acceleration in rent growth at the same time in 2025 and potentially even more so in 2026. And this is because the surge in interest rates put most new construction projects on halt. In some property sectors like industrial and residential, we saw construction starts drop by 70 to 80% in many markets. And so naturally, if you now have slower supply growth, but you still have the same demand growth in many of these sectors, naturally you're going to see rent growth accelerate. Right now, many apartment REITs like Mid-America Apartment Communities or Camden Property Trust are just enjoying 0 to 1% rent growth in 2024. Naturally, the market doesn't like this, and it's quick to extrapolate these recent trends far into the future, but I think that this is going to accelerate quite strongly in 2025. The CEO of BSR REIT, which is another apartment REIT, actually recently made a pretty interesting remark on their conference call. He said that the pipeline of new supply is very thin beyond this year, and with migration into our market continuing, we expect new supply to be absorbed by early 2025. We therefore believe that 2025, 2026, and 2027 and beyond will be significantly stronger years for our rental markets. And so this is true for most apartment REITs, but we see similar trends also happening for industrial properties. As an example, here's what the CEO of Prologis said on their most recent earnings call. He said that, I think what's important to understand in the cycle is the recovery potential in 2025 related to each of the constituent pieces. Hamid walked you through the demand picture, but what's important to recognize is the supply picture. That was a big factor over the past year, 18 months, and meaningful fall off in supply is now marked. It's off 80% from peak. It's off about 1/3 from pre-COVID levels. And so if we now see a strong acceleration in rent growth in many of these property sectors in 2025, even as interest rates are cut at the same time, I think that this is going to be a very strong catalyst for REITs. And this is why I think that the window of opportunity could now be closing as we approach the end of 2024. Again, I cannot predict exactly when REITs will recover. The market is a forward-looking machine. So in theory, as soon as this becomes clear to the market, REITs should recover already in anticipation of these things playing out. But who knows? But I think that this is really one of the main reasons why we recently saw Blackstone make massive REIT acquisitions. Blackstone, in case you're not familiar with it, is the biggest private equity company in the world. They control over 1 trillion of capital, mostly alternative investments like commercial real estate, infrastructure, private equity, and so on. And just recently, they acquired Tricon Residential, which is a REIT that we used to own in our core portfolio at High Yield Landlord. And they also acquired Apartment Income REIT, which is also another REIT that we used to own at High Yield Landlord, which is my REIT newsletter. So we profited from both of these transactions. In both cases, they were willing to pay pretty sizable premiums relative to the latest share price. And even then, they still thought that they were getting a good deal, because otherwise they would have simply bought private real estate themselves or developed their properties themselves. And so I think that the fact that we saw them really, ramp up the acquisitions now in 2024 tells you quite a lot also about what they're thinking. They're probably agreeing with us that the window of opportunity could be closing, and that's why they're really stepping up their purchases right now. And I don't think that this is just a wild theory from me, who is probably a bit biased towards REITs, because here's what Blackstone said on their most recent earnings call. So if you went back to the financial crisis in the summer of 2029, asset values bottomed. And for the next 3 years, you had lots and lots of negative headlines of troubled assets that came through the system. But if you were an investor, you wanted to start deploying capital back then, which we started doing in earnest. And I think that there's a lot of similarities to what we are seeing right now. So is there still plenty of bad news and headlines that will come through a system? Yes, but in the spot market has the impact already of higher rates reflected in real estate values? Yes. And so what we see us doing is making some very large announcements. We bought a bunch of senior loans. We did the signature bank transaction. We announced yesterday buying 1 billion of loans from a German bank. And importantly, we announced 2 public to private transactions in the rental housing space, 17 billion of enterprise value since the year started. So yeah, 17 billion obviously is very significant, even for a company like Blackstone. They've now bought in total, I believe, nearly 50 billion worth of REITs since the beginning of this bear market in 2022. And again, these are some of the most sophisticated real estate investors worldwide. They control hundreds of billions worth of properties. They know really well what are the fair value of different asset types, and they are pouring their money into REITs because they are heavily discounted relative to the fair value of the real estate they own. Earlier, I discussed BSR shortly. This is an apartment REIT that specializes in Texan apartment communities. Its latest share price is $11 per share, but their net asset value per share is about $18. So that's a 40% discount. And I think that if we were in the private market and I offered you to buy Texan apartment communities from me at 60 cents on the dollar, you'll probably jump on the opportunity. But somehow, because REITs are publicly listed, investors don't seem to be interested in this opportunity. They are scared of the volatility. They fear all these negative headlines that we keep seeing about commercial real estate. But the reality is that most of these companies are doing quite well. They have the strongest balance sheets they've ever had. Management teams are well aligned with shareholders. In the case of BSR, they are buying back a lot of shares to take advantage of this dislocation between public and capital markets. And now, as we go into 2025 and we see interest rates drop to lower levels, even as rent growth accelerates, I think that we're going to see these discounts close down quite significantly. And a rate like BSR, if it was going to recover to its NAV per share, that could unlock quite significant upside, much more than 50%, 50 to 100% in the case of many REITs. And so, yeah, this is my warning to you. I think that the window opportunity could be closing. Right now, REITs are still the cheapest since the great financial crisis. We've always been taught to invest when valuations are low after a crash. That's today. There are always reasons why assets would be priced at low valuations after a crash. And obviously investors are always scared and they always say those famous 4 words that this time it's different, but I really don't think that it is. REITs strongly recovered after the initial pandemic crash. Back then they had dropped by over 40% on average. 1 year later they had already fully recovered and more than doubled investors' money. A bit more than 1 year, I think it was 1.5 years. But in any case, I think we had a very strong V-shaped recovery. Maybe we will see the same thing happen in 2025, 2026. I don't know for sure. I cannot time the market. But again, I think that the risk reward is very compelling here. And this is why I'm pouring a lot of money into REITs at the moment. Now, if you want to access my entire real money REIT portfolio, you can join High Yield Landlord, which is my REIT newsletter for a 2-week free trial. I'll put a link to it in the description of this video. As I've said before, this is a real free trial in that you won't be charged anything in the first 14 days. We're also offering a limited time discount for the first year of your subscription. Finally, if you could please click the like button and subscribe to the channel, that will help me a lot to keep on growing. Thank you so much in advance. See you at my next one. Bye-bye.